horse race that some people are interested in. It's actually a larger crowd, Emily, than I thought we would have on here. It's like there'd be like 2 people. But anyway, I'm Mark LaMonica. We're going to talk about alternative investments today. First, we have housekeeping items. Anything you hear today is general advice. I can't obviously offer you personal advice because I don't know anything about you. If you're over in New Zealand, you go to our website, morningstar.com.au, to get a copy of our FAP. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. So, as I said, we're going to talk about alternative investments today. I'll try to end this a couple minutes early because I assume people, at least some people, want to go watch this horse race. But yeah, let's talk about alternative investments. So alternative investments is a very large category, but I also think, and we've got a slide in here, that it's relatively relevant for people given what's going on in the market. And Rodney says, what horse race? There you go. Yeah, I think relatively relevant to what's going on in the market. There has been some news lately about especially industry super funds that are holding larger and larger parts of their portfolio in alternative assets and the valuations, how they're valuing those assets. So that's been in the news. And then, of course, anytime there's a lot of market volatility, people look towards alternative assets. And we'll talk about what that means. So when we talk about traditional investments, very simply, we're looking at stocks, bonds, and cash. So pretty vanilla stuff. But then when we get into alternative investments, there is a large number of different categories of alternative investments, and they all behave very differently. So even though we are trying to do one session that looks at alternative investments, they are very, very different, as you can see just from the name. So we'll get into a little bit some of those differences. But one thing that's pretty clear is they are very popular and getting increasingly popular with investors. Now, this started with institutional investors. We'll get into a little bit of the history in a second, but it really started with institutional investors. But now there's a lot of retail products that are being offered. So another reason why this is timely. But basically, the shift is by 2016, there was $10 trillion US in alternative assets under management. And that's expected to more than double by 2025 to $21.1 trillion. So that's obviously indicative of the interest and really the history of alternative investments. There's a couple different places to start here. So one thing is certainly around hedge funds. Now, hedge funds come in a lot of different flavors, but really the advent of hedge funds came from the fact that traditional managed funds or mutual funds in the US, those traditional structures were not allowed to short any investment. So basically, shorting something is gaining when that investment goes down. Now, that can be used as a just very speculative bet, but traditionally it's used as a hedging strategy, hence hedge funds. So these hedge funds were set up originally to allow investors to short shares or the market. And that's why they're called hedge funds. Now, hedge funds have grown into a lot of different flavors. That was sort of the original advent of, I guess, the modern alternative assets, alternative investment arena. The other big event that happened was really around endowment funds in the US. So an endowment fund is a fund that a lot of universities or potentially other schools have to fund future scholarships or just take care of certain funding needs. And there was this guy by the name of Dave Swenson who was running Yale's endowment. Now, endowments traditionally invested in traditional investments, cash, bonds, shares, etc. And Dave Swenson started thinking about, okay, what is an endowment? An endowment is a fund that lasts in perpetuity, right? So you have very, very long time horizons and potentially time horizons that are even beyond lifetimes. So you've got very, very long time horizons. You have fairly predictable cash needs that need to come out of this, right? So as you make agreements with the universities, with the board of trustees about what will actually be dispersed from the endowment, you actually know what that is. And frankly, you've got a lot of cash coming in because you're going out there and you're still getting donors to donate into the endowment. So you're getting a lot of cash coming in that, of course, can be used to pay out what needs to be given to the university for the various things that are being funded. So he started thinking about, given this was a very unique situation, that endowments had a very unique situation, should they be investing traditionally? And his answer was no. And Dave Swenson recently died a couple of years ago, but he really kicked off this whole alternative investments boom that has expanded over the years. And he started buying, and he's basically looking for a premium from holding assets that didn't have liquidity. So let me try to explain that very quickly, that, one of the things that investors really like is liquidity. The fact that any moment I can go out there and sell shares. Anytime when the trading day is open, I can go out there and sell shares and I'll have cash in my account in a couple of days when they settle. People really like that liquidity. And, his theory was that investors actually overpay for that liquidity because that's something they like. That's something that they're willing to take a lower return on. And he thought, well, I don't need liquidity because I'm running this fund that is going to last in perpetuity. So if I want to go out there and buy, timberland in New Zealand, I should go do that. If I want to go out and buy agricultural land, I'll do that. If I want to take my money and give it to a manager and say, hey, private equity manager, you can have my money for 15 years. I don't need it back. He thought that the fact that there is no liquidity or very little liquidity in those types of investments mean that he would actually get a premium. And so Yale did very, very well. And of course, when you do well at anything, a bunch of people copy you. So what we've seen is sort of from this endowment model of investing, we've seen it expand to other endowments. We've seen it expand to pension funds, to super funds, all sorts of different places, that a lot of these managers are allocating more and more into these alternative investments. And there have been very strong returns, particularly around private equity and venture capital and some of these hedge funds. And we'll talk about sort of what the implications of that are in a second, but that's kind of the history, a very brief history of sort of where this stuff came from and then why it became more and more popular. And one thing, I went into Aussie Super and I just looked at two of their different investments. This one right here, and I couldn't capture the whole screen and have it fit on here, but that one right here is high risk. And this is their balanced fund. So what you can see is you start to go through, and we're seeing the same thing with these super funds, right? They obviously have paid attention to everything that's been going on, but they've got similar things, right? They have these pools of money for members that are very long, that have very, very long investment time horizons. Sure, they're going to have to pay out some people as they retire, but as long as more and more money is going into super, which is what we've seen over the years, right? As long as more and more money is going in, then once again, they have this very long life of these investments. So they've done the same thing and shifted to alternatives. So you can see here, and you can see they have pretty wide percentages that they're allowed to allocate. But if you start looking at these in private equity, unlisted infrastructure, even listed infrastructure, unlisted property. So unlisted infrastructure, unlisted property is either they're giving that money to an external manager, or potentially they're going out there and buying a building themselves. Certainly credit. So what you're seeing is they can allocate a lot into, and have, frankly, if you start looking at some of these percentages, into a lot of these alternative assets. So if you're invested in an industry super fund, you may have a fair amount of your portfolio in unlisted assets. Okay, good question by the anonymous attendee. So it says, do you think Australian super private equity might be overvalued? Yeah, so let's talk about this for a second. We're going to get into it a little bit later, but this is a good time to jump on it. This is also something that has been in the news a lot. So when I invest in shares, I know what they're worth every day. Right. So I can sit there, and if I am valuing a fund, if I'm valuing a super fund, I can sit there at the end of the day, right? And I can say, okay, The market's closed. Let me look at my portfolio. Here's what it's worth. And it's very easy because part of the reason of having a marketplace, a share market, is price discovery and the ability to, and this liquidity that we've all talked about, right? So if I need liquidity, if I need to be able to buy and sell investments at a whim, of course, I need to know what they're worth all the time. And that's what we see in the share market, right? So we're getting these constant updates on price. Now, this, of course, is not true if you are investing in a lot of these alternative assets. So let's look at some different categories. Like one, if we have, as I said, unlisted infrastructure, unlisted property, it means that you're out there, you own potentially with infrastructure, you could own a port, for example, or you could own a rail line, or you could own a toll bridge. So it's very difficult to value these assets. There's obviously nobody going in there every single day, like in the share market, offering up value. Same thing for private equity, for example. So private equity is something that invests in private companies. So they have owned the entire company, or they own a portion of it with another private equity firm or another institutional investor owning part of it. But either way, it means it isn't traded publicly. So I can tell you every day how much BHP is worth. But if BHP was a private company and it was not trading on the share exchange, I couldn't really tell you every day. So there is a criticism, including Anika Bradley, who works at Morningstar, wrote an article on this a little while ago that if anyone wants, I can send you. So just send me an email, mark.lamonica1@morningstar.com. And there's this criticism that they are basically not appropriately valuing these private assets. And they're doing that, whether deliberately or not. I'm not going to talk about rationale, but what this is doing is, of course, it can hold up returns, keep your returns higher in market environments like this, because you are basically not taking down the valuation level of private companies, which should make sense given the fact that public companies are going down in value. And a company very specifically that's been in the news a lot is Canva. So Canva, of course, is a startup in Australia. I literally live right next to it in Surrey Hills. And Canva had this sort of sky-high valuation. Now you're starting to get different institutions. It's a private company still. You're starting to get some of the investors marking down their investment, saying, okay, well, Canva is basically a tech company. It's a tech startup. We've seen what's happened to publicly traded tech companies. So it makes sense to bring down that valuation, but everybody does it on their own, right? So until there's another round of funding, there is no way for us really to know what Canva is worth. So if you have Australian Super that owns part of it, and I don't know that they do, by the way, I'm making that up. But if you have two different super funds and another private equity investor, and you have all these different entities that own it, they're all responsible for their own valuations, right? So one could say Canva's worth this, another could say Canva's worth this. And so, yeah, there's a lot of, I think, I don't know if criticism's the right word, but there's a lot of discussion about, are these private assets being valued appropriately by these super funds and by other investors as well. So yeah, it is a big question. So thank you for that question, anonymous attendee. All right, so let's talk a little bit about what are the characteristics of alternative investments. Now, remember, these are very generalized because, as I said, alternative investments are all sorts of different things. But let's talk a little bit about why people would invest in them. So there's this notion around low correlation to traditional investment. So what does that mean? It means that some investors are very concerned with correlation. So basically what that means is that they're trying to lower the volatility of their overall portfolio. So if one asset goes down, they would like another asset that goes up, right? So that's kind of what we're talking about very simply with correlation. Now, correlation and diversification are very different things. And I think that people don't completely realize that diversification just means that I am removing certain risks from my portfolio. I'm removing security-specific risks. I am not removing market risks. I'm not necessarily investing in different things to one would go up when the other one goes down. Like the big misnomer about that is shares and bonds, right? So if you go and you ask a lot of investors think, okay, well, I invest in shares and I invest in bonds because when shares go down, bonds go up. Well, that's not true, right? And we've seen it this year, right? So for instance, a very simple thing that happens is when interest rates go up, share prices generally go down and bond prices definitely go down. And we've seen that this year. Now, bonds are less volatile. So what they will do is they won't go down as much. So you can lower the volatility of your portfolio, but you're not hedging your portfolio, which is what you do with correlations, right? But some people are interested in doing that. Now, my argument would be if you have a long way to go before you need to spend this money, that this correlation doesn't really matter, but there are very specific times in your life when it could matter. There's this notion that you get higher returns. So it's this liquidity premium, right, that I was talking about earlier with Dave Swenson. So there's this notion you get higher returns from things like hedge funds and private equity. Now, if you go back in time and you look at the returns, they've been very, very strong. I think the concern that a lot of people have, that I have as well, is, the returns were very high when there was very little competition, right? So that stat that we talked about earlier, that, in 2016, there's 10 trillion US globally in alternative investments, and it's going to double. Well, that means the competition increases, right? And what happens when there's more competition? Well, for one thing, and it's a very simplistic example, for one thing, if you're a private equity firm and there's a lot of competition, meaning there's a lot more money that's sitting in your own fund and all the other private equity funds, what happens when there's an attractive company out there to buy? Well, you've probably got a lot of bidders. What does a lot of bidders do? It sends the price up. So of course, if they're paying more for these companies, they're going out there and buying. If there's more competition, what that means is higher prices, lower returns. So the question is sort of what those returns will be going forward. And the one other thing I guess I would add, and we'll get into sort of individual investors and how you can access this. The other worry that I think a lot of people have, myself included, is there are clearly firms that are very good at this. And those firms, of course, are impossible for us to access because when they go out there and they raise money, what's the easiest way to raise money? Is it to go ask 1,000 people for $10, or is it to go find one person that will give you all the money you need? Well, it's easier to find one person. So if you are the best, and you have these amazing track records, whether you're a venture capital firm, whether you're a private equity firm, whether you're a hedge fund, well, you're not just going to take money from anyone. You're only going to take money from people that are easy for you to deal with, which means less investors, which means people that have very good reputations that is going to be a long-term investor and frankly not bother you that much. And so it's hard for the little guy to get access to some of the top talent. And the question is, particularly if you look at sort of the hedge fund world, the private equity world, the venture capital world, that top talent, the people with all the connections, if you're in the last quintile of poor hedge funds, are they really going to do that well? So yeah, my argument would be probably not. All right, so good comment from Rodney, of course, who I've always said should just be doing these. So he says, one issue is mark to market isn't happening, and also that trusting a singular valuer has an issue. So mark to market basically just means it's what's happening all day with security prices on the exchange. You always know what the market is, but if there's no market, you mark to market means that you're going to go in there and you are going to make adjustments at certain times to the valuation, so it reflects the market reality. Yeah. So, and here's a really good point by Rodney. He says, it's also a problem that if there is a lag between now and a revaluation in a down market, like what's happening now, that means that all the people putting money into super may be significantly overpaying for those individual investments that they're making, right? So this is that lag. So in a share market, there's very little lag. Right. So yeah, your quotes are probably delayed 20 minutes, but still, like, there's very little lag, right? You can go in there and see what your portfolio is worth if it's invested completely in public companies all the time. All right. So literally, depending upon where you're getting your market data from and those quotes updated, could be 20 minutes, could be less if you're getting real-time data. The problem is nobody's sitting there valuing a building every single day, right? So maybe on a quarterly basis, there is this process that they go through and revalue this building. Well, for a whole quarter, the building might have been overvalued, particularly when things are rising and falling really quickly. So that's a really good point, Rodney. So this is what I was talking about, less liquidity. So for many investments, depending upon what you're investing in, if you think about, let's talk about private equity, for example. So of course, the whole deal with private equity is I give you my money, and then you have to go out there, you have to find a company to buy. You have to buy that company. You have to do something to that company to add value. So either you are going to the cynical side of me, you could go in there and load the company up with debt, pull all that money out, and then sell it off or spin it off. That's a cynical view. What a private equity fund would probably say is they're going to go in there and fix that company, that they found this company that has all these operational problems, and basically management are doing a really poor job. So they're going to go in there, they're going to fire management, they're going to fix the company, make it better, and then they'll sell that. Either way, all of this takes a lot of time, right? And so like, if you guys are reading the news right now, this is what's happening at Twitter, right? So basically, Elon came out and said that the company is being run terribly, all sorts of different problems with it. They're not reaching their potential. He bought it. He's fired all of their management. Now it seems like he's going to fire half the company to take cost out, but he's going to try to fix it, right? So that's the approach that he has taken. He's also taken on something like $13 billion worth of debt, which they can barely afford to pay off. So we'll see what happens with Twitter. High minimum investment requirements. So that's kind of what I was talking about before, that a lot of these funds, certainly the really good ones, are only taking institutional money because they only want to take very, very large amounts of money. That whole thing about going out there and trying to source money. So typically very, very high investment returns. And so over here, what we basically have, once again, to screw with my inability to see colors, we are looking at how returns have fared during different times. So you can see here, not great during the financial crisis, but in things like the bursting of the tech bubble, alternatives did better than equities, did better than a 60-40 portfolio. So you are seeing how these perform during certain times. So something that a lot of proponents of alternative investments will talk about. All right. So why are investors turning to alternative assets? Well, this has come down a little bit, but still equities traditionally, or at least average at this point. This whole TINA thing, interest rates are starting to get higher, but they're still pretty low, right? So, as individual investors, we're out there searching for yield, searching for returns, meaning we're taking on more risk. So are, of course, all of these large institutions that have these liabilities that they need to pay in the future. So whether you're a super fund that knows you need to pay out your members, whether you are an endowment that needs to pay the school certain amounts, you've got these liabilities in the future, and you got to get return from somewhere, right? So this, once again, is that whole notion of going further out on the risk spectrum. And yeah, investors are planning for higher inflation, which is here. So yeah. All right. So basically, alternative investments fall into three different categories when we start looking at what we would call liquid alternative investments. So liquid alternative investments are ones that have more liquidity than that example I gave with private equity, where they want your money for 10 years. So we're looking at things that do have a little more liquidity. Now, there's really three different things that you are doing when you're trying to invest in an alternative investment. So one, in this sort of traditional category, we're looking for protection in market downturns. So modifiers, right? So what we're looking for, if we talk about long short equity, we can talk about what that means for a second. So long short equity is really like the traditional hedge fund. It's kind of how a hedge fund started. And they're very simple, and there's all sorts of approaches you can take. But one very simplistic approach you can take is you want to remove market risk from a portfolio, but keep individual security risk. Now, that's different from what I would want to do if I was diversifying my regular portfolio. Remember, like, I don't want to put all of my money into, for using this example, all my money into BHP. And I don't want to do that because that's one company and anything could happen at BHP, all right? Management could screw up, make a bunch of dumb decisions. China could stop buying their iron ore. They could have all sorts of problems. They could run up too much debt. Like, all sorts of things can happen with BHP. So the reason I build a diversified portfolio is I want to take that BHP specific risk out of my portfolio, and I want to take on market risk. And the idea here is that the market will go up over time. So I'm taking on market risk, and to the extreme, I would buy the whole index. All right. So then I get that market risk, but I have very little to no security specific risk. Whereas if I had a portfolio, and the BHP example is probably a little much, you wouldn't buy one share. But even if I go out there and put 10, 15 shares in that portfolio, what matters then is what I'm picking, right? You're still getting a lot of that security specific risk. But long short equity, to its extreme, does the opposite. So what a manager is basically looking to do with a long short equity fund is they are looking to remove that market risk and focus on security specific risk. And the very simple example of how you do that is I can sit there and say, all right, I've got two shares, two companies that are relatively the same. I've got CBA and I've got ANZ, all right? They both do the same thing. Like, sure, there are minor differences, but they both do the same thing. Now, they're both exposed to changes in interest rates. They're both exposed to the Australian economy. They both have kind of the same products and just individual things that could happen in those products, whether it's mortgage lending or whether it's business lending. So what I do as a manager, I say, okay, my skill is that I'm able to pick the best one of those two. I can go in there and say, I think CBA is better than ANZ, or vice versa. So what would I do? I would basically pair them up, and I would go long one. So let's say I go long CBA, and then I go short ANZ. So what I'm effectively doing there is I am removing market risk and leaving security specific risk. So over time, even if things are going terribly for banks, over time, if they go less terribly for CBA, which I'm long, than ANZ, I'll make money. So it's basically me removing that market risk, the risk that something crappy could happen and all banks would go down, or something happens to the market and all banks go down. I just need ANZ to go down more, and I profit off of that. So that's really what we're looking at, this modifier. This is this protection in downturns. So derivative income, those can be like option strategies that a lot of people use to sort of generate income off of options. Yeah, this is just an asset allocation strategy. Basically me sort of shifting around a lot, taking a tactical view on asset allocation. I won't go through each one of these. Then we can have diversifiers. And diversifiers are basically if there's a very specific risk that I am trying to get rid of, I could use a diversifier. And then we've got this idea of like absolute return. So an absolute return is supposed to give you a return, not as high as a return as the market, but give you a return no matter what is happening. And what we wanted to offer here, or what I wanted to offer, was some alternatives. Because the problem with a lot of these alternative investments is they're very expensive. They're difficult to understand. And we'll look at a couple of them in a second, but they're very difficult to understand. They're very expensive, and there's a lot of worries for individual investors when they invest in them. So I was looking at alternatives. So what's one way that you can protect yourself in market downturns? We can hold more cash, right? It's a pretty easy way to protect yourself. Now, are you going to get a lot of return off of that? No, but you do have the opportunity to protect yourself by having some cash. What's one way to diversify? You can just diversify in your regular portfolio, right? You don't need all of this. There are opportunities from a risk management perspective that you can really diversify. And whether that's into different asset classes, non-alternative asset classes that are easy to access, or using things like cash, you can do that. And then the sort of opportunistic, like I need this absolute return stuff where I need returns every year. Well, if you have enough time, you're most likely going to get positive returns. So just some things to think about. All right, we won't spend too much on this slide, but basically what we're looking at here is we are looking, and that is spelled correctly, by the way. It's Shawnee's nice way of using a little finance jargon. Basically, we're looking at all the different issues you may have if you are investing in alternative investments. So I'll just touch on a couple, but yeah, they're complex. A lot of them use a lot of debt. Certainly things like private equity, there's a lot of debt involved, which can cause problems. Accessing, and when we're looking at liquid alternatives, we're looking at something that does have some more liquidity than that traditional tie-up period. Yeah, a lot of the strategies just don't work with that, right? Like private equity doesn't really work with that. For an example, you're paying a lot for fees, which is not great. So yeah, lots of different issues with that. So when we go and we look at a good alternative investment, and I've obviously given my view that, I like the strategies in general. I just worry about people's ability to access it. These are all pretty, hopefully, straightforward. So yeah, what do we want? Obviously, experience, resources, all the same things that we would use to judge any fund or ETF. We're looking at their process. Risk management can be really, really important because these things do blow up. And kind of the big example is a hedge fund called Long-Term Capital Management, which was in Greenwich, Connecticut, which is where I grew up. I had nothing to do with them collapsing. They hired a bunch of Nobel laureates and almost caused this global financial meltdown because of a bunch of leverage they took on in some of these like pretty tricky fixed interest strategies they were investing in. It was kind of like the first bailout of financial institutions way before the GFC. There's a good book. I don't remember what it's called, but there's a good book on long-term capital management. So that's important. And yeah, leverage, as I said, is a bit of a problem. And of course, we want to see a good track record. So, those are things we look at. Should be kind of pretty general. As I said, if you were thinking about investing in a lot of these strategies, remember, like, the sales process will be great. Like, oh, I'm invested in private equity. Like, you can go and explain to your mates about, this like complicated strategy you're in and how you're a genius for doing this. But there's probably alternatives to it that are cheaper that may be able to have you achieve. Yes, they're going to set up the Melbourne Cup party. Emily can barely stay in the room. She's so excited. But she has a meeting with me afterwards, so we'll see if she skips it. There are certainly other ways that you can probably get most of the benefit in a lot of an easier, cheaper way. Can you get access to a good manager? That's a huge, huge question. Just think about that. Think, why you? Is this thing being offered to you and not some super fund that has billions and billions of dollars? Like, why are you getting access to that? I would always think about that. So yeah, a lot of sort of concerns. And I do have Aussie Super, so that's why I put that Aussie Super thing up. And I do like the fact that does give me the ability to access some of these asset classes that I can't in all my other accounts, but through an enormous fund, right? Who has a better chance of going out there and getting good managers. So just through a couple of, and I won't go through these, but yeah, through a couple of these funds you can actually invest in as an individual investor. So you can see only 3 of them we have rated as bronze. Most of them are neutral, but these are different funds that you can use to go out there and get some of these strategies that we talked about, absolute return, et cetera. So there are opportunities for you to go out there. Okay, so we've got a question from Angela. What do you think about investing in physical gold and silver in a small percentage? Yeah, once again, I think it's kind of what you were trying to achieve. I personally don't invest in gold and silver. So there are 2 different options you have basically. So you can, of course, gold and silver, they're commodities. You can go invest in a gold or silver miner, right? So companies going out there, you can go buy a coin or a brick or a bar. You can do that. Yeah, I think it's what you're trying to achieve. Like, my kind of personal opinion is that when you go and you sit there and look at like what people say gold does and what it actually does, yeah, I don't know. Like, so gold is of course supposed to be a kind of safe haven during times of economic stress. Yeah, I don't know. People are saying the same thing about Bitcoin. Obviously, gold has been around for a very long time. But yeah, I just think it's just thinking about what you're trying to achieve, realizing that, yeah, you're not getting any cash flows. You're not getting any cash flows from those assets. So yeah, I don't know. I can't tell you what you should do, but yeah, just think about what you're trying to achieve and then go back and really look at not just the sales pitch for gold and silver, but go back and look at sort of historically, have they done this? And I'd say that gold and silver are very different. So, silver does have more industrial uses. Gold's kind of a store of value. And then, yeah, like a huge percentage of the market actually goes to India for jewelry. But yeah, they're different. So Rodney says there are quite a few LICs, managed funds, et cetera, in Australia covering various alternative asset classes. Any thoughts on those? Any plans for Morningstar have alternatives or research coverage of them? Yeah, we are actually looking to and will be expanding our research coverage kind of the middle of next winter for funds like ETFs, et cetera. So I'm sure a lot more of those will be included. So, our manager research team, who's the ones that cover all this, is kind of looking at a couple different things when they're making decisions. Like, one, are these popular with investors, and also are they popular with financial advisors? Because we do sell our research to financial advisors as well. So yeah, I mean, I think if they become more popular, as they become more popular, they could get on that coverage universe. But yeah, we're going to expand it next winter. All right. So I'm going to end it there. So everyone has 20 minutes to go put their fascinators on. How long do you think it'll take you? A bit more. Okay. So there's a best dressed in the office competition today that I certainly will not win because I'm wearing the same thing I wear every day, but I think Emily's going for it. So we'll see. All right, we've got a question from Sally. So hold on, don't put on your fascinator yet. How do I determine whether Australian super high growth or uni super high growth fund would be a better cost-effective manager, or would be better to invest in trusted managers such as ETF Vanguard Fund Management? Yeah, listen, I would say that Australian super and uni super are probably, fall in the category of trusted managers. What I would say is they're very, very different from Vanguard. So, Vanguard is trying to give you basically exposure in many ways, and Vanguard does have active funds as well. What they're trying to give you is a bunch of very low cost index products, which has worked very well. They're doing very different things at Aussie Super and at Uni Super. They are active managers. They are going to give you a lot of exposure to things, as we talked about today, like private assets. And both Australian Super and Uni Super do have really good track records. Cost is very dependent upon how much money you have. So if you go and look at, obviously one of the problems with a lot of super funds is that it's sort of this mix between there's a management fee based on how much money you have, then there's kind of fixed costs that you're paying as well. So it kind of depends upon your personal situation. Vanguard is making a pretty big push, but Sally, if you send me an email, I will send you an article looking at Aussie Super versus Vanguard that was written by our manager research team. So maybe that could provide some insights. And we do rate Aussie Super as well. So our manager research team rates it. So I can send you that research as well. So yeah, just send me an email at mark.lamonica1@morningstar.com and I will send that to you. All right. Now we will go put on a fascinator, right? All right. Well, anyway, thank you guys for joining. I hope everyone enjoys this horse race this afternoon.